Today, the structure of the silver market changed, and the consequence is not simply a 5% decline or a temporary reaction to headlines, but a measurable shift in probability that alters how risk must be assessed from this point forward. When silver falls sharply while the dollar strengthens and Treasury yields rise simultaneously, that is not noise. That is a repricing of liquidity preference. The metal did not just drift lower, it broke below a key equilibrium zone near $85 per ounce before stabilizing closer to $87, and that move forces a reassessment of how capital is allocating under stress. When safe haven demand fails to dominate during geopolitical escalation, something deeper is occurring beneath the surface of the tape. The implication is not that silver's long-term thesis is invalid, but that the short-term liquidity regime has tightened. And when liquidity tightens, volatility expands. Silver had been trading in a relatively stable range, compressing energy just under the $90 region, with $85 acting as a pivot area where buyers previously absorbed supply. The break below that zone, even if temporarily, signals that the balance between speculative longs and defensive hedgers shifted. Price does not decline more than 5% in a mature consolidation without triggering forced repositioning. That repositioning matters more than the headline percentage move. It reveals who was leaning the wrong way and how aggressively capital needed to unwind. The catalyst was not isolated. The dollar strengthened as investors moved into the reserve currency amid escalating tension in the Middle East and surging energy prices. In normal conditions, geopolitical risk can support precious metals. However, when energy prices surge aggressively, inflation expectations rise with them. That inflation pressure does not automatically benefit silver in the short term. Instead, it pushes Treasury yields higher as bond markets reassess future policy. Rising yields increase the opportunity cost of holding non-yield-bearing assets. The result is a mechanical pressure against metals when real rates climb. That dynamic overpowered safe haven flows, at least temporarily. Treasury yields rising in tandem with a stronger dollar creates a tightening impulse across global markets. Capital becomes more selective. Funding costs increase. Leverage becomes more expensive to maintain. Silver, which often carries a high speculative positioning component due to its volatility, is particularly sensitive to this kind of macro tightening. When the market begins to defer expectations for a Federal Reserve rate cut, the forward liquidity window shifts. Earlier projections were leaning toward a potential easing in July. Those expectations have now been deferred towards September, even though 225 basis point reductions remain priced into longer-term expectations. The delay changes timing assumptions. Timing is critical for leveraged assets. A deferral in easing does not sound dramatic, but in a highly leveraged system it recalibrates risk models. Traders who positioned early for a July easing now face a longer carry cost. That carry cost forces decisions. Either reduce exposure or absorb drawdown. When enough participants face that same decision simultaneously, volatility accelerates. That acceleration is exactly what silver experienced when it broke below the $85 region. At the same time, geopolitical escalation introduced an additional layer of uncertainty. The United States military is expected to intensify strikes on Iran, potentially targeting missile production facilities, drone infrastructure, and naval assets. In response, a senior Iranian official warned that vessels attempting to transit the Strait of Hormuz could be targeted. Tanker traffic through that corridor has effectively stalled amid heightened security risks. The Strait of Hormuz is one of the most critical energy choke points in the world. Any disruption there amplifies crude oil volatility. Rising oil feeds directly into inflation expectations. Inflation expectations feed directly into bond yields. Bond yields feed directly into real rate calculations. Real rates feed directly into precious metal pricing. This chain reaction is what matters. Silver did not fall simply because investors ignored safe haven demand. It fell because the inflation shock from energy tightened financial conditions through the rate channel faster than safe haven flows could compensate. That is a structural distinction. It reveals which macro force currently dominates the pricing equation. The current price near $87 suggests that some stabilization occurred after the initial flush below 85. However, reclaiming 85 is not the same as repairing structure. The market must demonstrate sustained acceptance above prior breakdown levels to neutralize downside momentum. Otherwise, the area between 85 and 88 becomes a supply zone where trapped longs distribute into rebounds. That is how trends extend. What broke specifically was the short-term higher-low structure that had been forming since the last retracement. Silver had been printing progressively higher support zones, compressing volatility while holding above 85. The violation of that pattern invalidates the immediate bullish continuation thesis. Probability shifts from breakout expansion to either range repair or deeper retracement. That does not guarantee collapse. It simply widens the distribution of possible outcomes. Liquidity sits at the center of this transition. Liquidity is not just cash in the system. It is the willingness of participants to transact at progressively higher prices without demanding additional compensation. When yields rise and the dollar strengthens, global liquidity effectively tightens. Foreign buyers face currency headwinds. Margin requirements become more burdensome. Hedge funds recalibrate exposure. Dealers widen spreads. All of these micro adjustments accumulate into macro pressure. Volatility risk increases when positioning is crowded. Silver often attracts speculative inflows during periods of bullish momentum because its percentage moves exceed those of gold. That leverage works in both directions. A 5% decline can trigger margin calls in highly leveraged accounts. Margin calls are not optional. They force selling regardless of conviction. Forced selling creates air pockets where price drops faster than fundamentals change. That is why the break below 85 mattered psychologically. It likely activated stop losses layered beneath that region. The interplay between geopolitical stress and tightening financial conditions creates a volatility paradox. On one hand, conflict risk supports long-term demand for tangible assets. On the other hand, the immediate inflation shock elevates yields and strengthens the dollar, which suppresses metal prices in the short term. The market must choose which force dominates at each moment. Today, the rate channel dominated. As we move forward, the macro layer becomes decisive. If energy continues rising and yields climb further, silver could remain under pressure despite geopolitical instability. Conversely, if yields stabilize or retreat while geopolitical risk persists, silver could recover rapidly because speculative capital would re-engage. The key is not predicting direction, but understanding which variable leads. The structural shift we are observing is a transition from momentum-driven optimism to liquidity-sensitive caution. The transition changes how rallies behave. Instead of impulsive continuation, rallies may become corrective bounces unless supported by falling yields or dollar weakness. Market participants must now track not just price, but cross-asset confirmation. In essence, silver's decline below 85 and stabilization near 87 signals that the probability framework has expanded. Volatility is no longer compressed. Liquidity is being tested. The next phase will depend on whether financial conditions continue tightening or begin easing again. The macro layer is now fully engaged. The core issue now is liquidity mechanics, because once structure weakens, the next driver is not sentiment, but funding pressure. Silver does not trade in isolation. It trades inside a leveraged ecosystem dominated by futures positioning, margin requirements, dollar funding flows, and Treasury yield volatility. When price broke below $85, it was not simply a chart event. It likely forced adjustments across COMEX positioning that amplify short-term instability. To understand what comes next, we must understand how leverage transmits stress. COMEX silver futures represent a multiple of the physical metal underlying each contract. That leverage allows participants to control large nominal exposure with relatively small capital. When volatility expands, exchanges adjust margin requirements to reflect higher risk. Even without formal margin hikes, a 5% price decline increases the mark to market losses on long positions. If those positions were built aggressively during the prior consolidation above 85, the decline forces either additional collateral posting or liquidation. Liquidation is not a thesis decision. It is a risk control decision imposed by the system. Margin pressure is nonlinear. When price declines into a known support zone and then breaks through it, stop losses cluster. Algorithmic systems recognize those clusters. Liquidity thins as bids are pulled. The result is a cascade dynamic where selling feeds on itself until a new equilibrium emerges. That is likely what occurred during the drop below 85 before stabilization near 87. The question now is whether that stabilization represents genuine demand or simply temporary exhaustion of sellers. The distinction between paper positioning and physical demand becomes important here. Paper silver can expand rapidly through futures and options. Physical supply cannot adjust as quickly. In a tightening liquidity environment, paper liquidation can overwhelm near-term pricing even if physical demand remains stable. That imbalance creates disconnects where spot prices fall despite underlying industrial consumption remaining intact. Eventually, if the disconnect grows too large, arbitrage flows restore balance. But the restoration can take time, especially when dollar funding is restrictive. The dollar's strength is central to this phase. As energy prices surge due to Middle East instability and the threat of disruption through the Strait of Hormuz, global capital seeks the reserve currency. A stronger dollar tightens financial conditions for commodity importers. It also mechanically pressures dollar-denominated assets like silver. When the dollar index rises in tandem with yields, it signals capital prioritizing safety and income over inflation hedges. That rotation reduces immediate speculative appetite for metals. Treasury yields rising amplify the pressure through real rate calculations. Silver is sensitive not just to nominal yields, but to real yields, which reflect inflation, adjusted returns on safe assets. When oil surges, inflation expectations initially rise. But if bond markets interpret that inflation as persistent enough to delay Federal Reserve easing, nominal yields rise faster than inflation expectations. Real yields therefore increase. Rising real yields raise the opportunity cost of holding silver. That dynamic shifts portfolio allocation models used by institutions. The deferral of expected rate cuts from July toward September extends this real yield pressure window. Even though 225 basis point reductions remain priced over the longer horizon, the delay forces recalibration. Carry trades become more expensive to maintain for an additional cycle. Leveraged long silver positions must absorb higher funding costs for longer than anticipated. That subtle timing shift can produce outsized effects in derivative-heavy markets. China and Shanghai flows add another layer. When the dollar strengthens and global risk rises, Chinese importers face currency translation costs. If the yuan weakens relative to the dollar, purchasing dollar-denominated silver becomes more expensive domestically. That can temporarily reduce incremental buying pressure from Asia. Meanwhile, if domestic Chinese investors pivot toward local assets or government bonds amid global tension, cross-border commodity flows slow. Silver is globally priced but regionally accumulated. Any friction in cross-border capital reduces marginal demand. We must also define reclaim and failure levels within this context. The $85 region now functions as a structural pivot. Sustained acceptance above 85, with expanding volume and declining yields, would suggest the breakdown was liquidity-driven, but not trend-forming. Failure to hold above 85 on subsequent retests would reinforce the idea that it has transitioned into resistance. Above that, the $90 zone represents a broader reclaim level where prior consolidation capped upside. Below current pricing, failure to hold the mid-$80 area could expose deeper retracement zones where longer-term participants evaluate value. Volatility traps form when markets oscillate around broken structure without clear follow-through. In such environments, both bulls and bears experience whipsaw. For example, a rapid rebound from 87 toward 89 could attract breakout buyers anticipating a full recovery. If yields simultaneously remain elevated, that rebound may stall and reverse, trapping late entrants. Conversely, sharp dips toward 84 that fail to extend lower could trap short sellers if dollar momentum fades. The volatility trap environment is characterized by wide ranges and declining conviction. Institutional desks monitor cross-asset confirmation to avoid these traps. If silver attempts recovery, they look for concurrent weakness in the dollar and stabilization in yields. Without that confirmation, rallies are suspect. Likewise, if silver weakens further but yields plateau and the dollar stalls, downside may lack fuel. This intermarket alignment determines sustainability. Paper versus physical imbalance can also create asymmetric squeezes. If managed money net long positioning declines sharply due to liquidation, the market can reach a point where speculative length is reduced enough that further selling pressure diminishes. At that stage, even modest physical demand can trigger outsized upside reactions because there are fewer leveraged sellers remaining. That is how reversals form after violent declines. However, timing that shift requires evidence, not assumption. Energy remains the wild card. If tanker traffic through the Strait of Hormuz remains stalled and crude oil prices continue climbing, inflation expectations may reaccelerate. Should bond markets interpret that as requiring prolonged restrictive policy, yields could push higher again, renewing pressure on metals. Alternatively, if geopolitical escalation stabilizes and oil retraces, yields may ease, providing breathing room for silver. The path of energy directly influences the rate channel. We also cannot ignore psychological conditioning. Market participants who expected silver to behave purely as a safe haven during geopolitical tension have just experienced a contradiction. That contradiction forces cognitive reassessment. Some will reduce exposure because the narrative did not perform as anticipated. Narrative breakdown often precedes positioning shifts. When conviction weakens, liquidity thins further. In summary, the silver market is now navigating a liquidity recalibration phase driven by rising yields, dollar strength, deferred rate cut expectations, and geopolitical energy shocks. The $85 pivot defines structural integrity. The $90 region defines broader momentum recovery. The mid-$80 area defines downside risk containment. Between these zones lies elevated volatility shaped by margin mechanics and cross-asset flows. The next decisive move will likely emerge from alignment or divergence between yields, the dollar, and energy pricing. Understanding that interaction is essential before drawing directional conclusions. Institutional psychology now becomes the decisive variable because after a structural break in liquidity recalibration, markets transition from mechanical adjustment to behavioral interpretation. Silver is no longer trading inside a complacent compression phase. It is trading inside a regime test. When a market violates support near $85, stabilizes near 87, and faces simultaneous pressure from rising yields and a stronger dollar, participants are forced to redefine conviction. The next move will not be driven solely by headlines or technical patterns. It will be driven by how capital interprets risk under uncertainty. Institutions think in probabilities, not predictions. After the decline below 85, the probability distribution widened. Prior to the breakdown, continuation toward 90 and beyond was a dominant scenario because structure was intact and volatility was compressing. Now the distribution includes a deeper retracement scenario with materially higher odds. That does not mean collapse is inevitable. It means the confidence interval around bullish continuation has narrowed. There are two primary scenario pathways emerging from current conditions. The first is a bullish repair sequence. For this to develop, silver must demonstrate sustained acceptance above the $85 pivot while cross-asset conditions improve. That requires stabilization or decline in Treasury yields, moderation in dollar strength, and at minimum a pause in the energy-driven inflation shock. If yields retreat even modestly while geopolitical tension remains elevated, silver could regain safe haven sponsorship without facing the headwind of rising real rates. In that case, price could rotate from corrective behavior back into constructive accumulation. The $90 region would then become the confirmation threshold. A decisive reclaim of 90, accompanied by expanding participation and narrowing bid-ask spreads, would signal that liquidity stress has eased and that institutional buyers are rebuilding exposure. The second pathway is a deeper unwind scenario. This would unfold if yields continue climbing, the dollar extends strength, and energy volatility reinforces inflation persistence. In that environment, real rates would likely remain elevated or rise further. Silver would struggle to sustain rallies. The $85 area would function as resistance rather than support. Each rebound toward 85 to 88 could attract selling pressure from trapped longs seeking exit. If price begins printing lower highs beneath that band while failing to reclaim 90, the probability of an extended retracement increases. That retracement would not necessarily invalidate the broader long-term thesis for silver, but it would reflect a cyclical correction aligned with tighter financial conditions. Confirmation signals must be defined clearly. For bullish repair, confirmation includes lower Treasury yields on a sustained basis, a softer dollar trend, and visible stabilization in energy markets. Additionally, silver must hold above mid-$80 territory during pullbacks and demonstrate impulsive upward extensions rather than labored rebounds. Rising open interest alongside rising price would suggest new capital entering rather than short covering alone. Those conditions collectively would indicate structural repair. Invalidation signals for bullish repair are equally important. If silver attempts to rally above 85 but repeatedly fails while yields remain elevated, that indicates the rate channel still dominates. A daily close materially below the mid-$80 area with expanding volume would suggest that liquidity pressure has not fully flushed. In that case, defensive positioning would remain appropriate until cross-asset confirmation improves. Institutional desks also evaluate cycle windows. When a market transitions from compression to expansion, volatility clusters. That means larger swings occur in shorter timeframes. Participants adjust risk budgets accordingly. Instead of assuming smooth trend continuation, they prepare for wide-range oscillation. This adjustment often leads to reduced position sizing, which in turn decreases immediate follow-through momentum. The market may appear indecisive not because direction is unclear, but because capital is calibrating exposure. Psychology is further complicated by geopolitical uncertainty. Escalation involving potential strikes on missile facilities, drone infrastructure, and naval assets introduces tail risk into global trade routes. The warning regarding vessels transiting the Strait of Hormuz underscores that risk. Tail risk can create sudden demand for tangible assets. However, if that demand coincides with rising yields, institutions must weigh the trade-off between inflation hedge and income generation. The balance shifts dynamically. Silver sits at that intersection. One critical observation is that silver's recent behavior demonstrates sensitivity to the rate channel above all else. Despite conflict risk, it declined when yields rose. That tells institutions which lever currently holds priority. Until that hierarchy changes, models will assign greater weight to rate expectations than to geopolitical headlines. Therefore, monitoring Federal Reserve communication and bond market reaction becomes essential. If future guidance signals sustained restrictiveness beyond current assumptions, the liquidity headwind could persist. Conversely, if economic data weakens sufficiently to pull forward easing expectations again, the recalibration could reverse. Probability analysis also considers positioning exhaustion. If speculative length has already been materially reduced during the decline below 85, downside momentum may begin to fade even without dramatic macro improvement. Markets rarely move in straight lines. Once leveraged sellers are cleared, supply diminishes. That can create sharp counter-trend rallies. The distinction lies in whether those rallies evolve into higher highs or stall beneath resistance. Institutions will test size only after confirmation. Another element is the perception of value. Long-term allocators assess silver relative to gold, industrial demand projections, and currency debasement risk. If price stabilizes near 87 while macro stress persists, some may view that as attractive relative value, particularly if gold remains firm. Cross-metal ratios often guide capital rotation. A narrowing ratio driven by silver underperformance can attract rebalancing flows. However, disciplined analysis resists narrative temptation. The objective is not to predict that silver will surge or collapse. The objective is to map conditions under which each outcome becomes more probable. Currently, the market sits in a transitional regime where liquidity sensitivity dominates. That regime demands patience. The disciplined close is this: silver has shifted from a momentum-driven environment to a cross-asset dependent environment. The $85 level defines structural integrity. The $90 level defines momentum restoration. Treasury yields and dollar trajectory define macro pressure. Energy volatility defines inflation expectations. Institutions will wait for alignment before committing aggressively. Until alignment appears, volatility remains elevated and conviction remains conditional. The structural shift that began with the break below $85 has not resolved. It has simply entered its evaluation phase. Probability, not prediction, must guide positioning.